Bobby,
Dan, how are you doing, sir?
my God, how you doing?
I'm doing well. I'm doing well. How was your day?
It was great. It's How many Zoom meetings did I do today? Probably six. And
Yeah.
I share, how many 6 months ago I didn't know what Zoom was, and it's part of the new reality, which is okay because it's amazing how just the landscape has changed so much, and everybody's working remotely now, and just everything has changed. And it's amazing how a little thing, this little pandemic, is like made global repercussions, and mostly in a positive way too, wouldn't you think?
I mean, I totally agree. It's a little thing to you and I because real estate never really stopped, right? But I mean, to the rest of the world, I suppose it's a huge thing, and it's amazing to watch people adapt. I took 4 Zoom calls. Probably shouldn't even say this, but I took 4 Zoom calls with the in the car with the windshield phone holder so people can see me and I'm talking to them. But hands free, I promise, hands free. But it's wild, eh? It's kind of the new expectation that we're capable of doing this.
Yeah. Yeah, it's unless you're in a Google car, you're just going to run into the car in front of you eventually.
Exactly.
Okay, well, I guess should we wait a few minutes and give people a chance, or are we good to go?
Yeah, let's leave it another minute or two. I see a bunch of people coming in. All right, let's give people a chance to finish their dinner and turn off the Jays game because they're getting smashed again. Oh my goodness.
Yeah, yeah. Don't get me started.
Oh my goodness. I heard you were meeting. Is this true? I heard you were meeting with a local group of business owners today. You do a lot in the community, eh?
Yeah, you know what? Yeah, there's a lot of community involvement. I do. Today was more. It was what we call a BNI, so it's like business networking. And to be honest, it's really cool because you get 40 people of like minds in a room, all from different disciplines. So everybody runs a different business. And so the information exchange and the information sharing is huge. And so, ultimately, we're just trying to send each other referrals and look after each other. And it works out really, really well. So, yeah, I did that. Typically, we would meet and spend 2 hours in a conference center. But now that was one of my Zoom meetings. But I'm surprised how productive you can be on Zoom. It's pretty cool.
It's amazing to hear. I mean, I don't know that I've known you all that long, probably the last 4, 5, 6 months, something like that. To see everything that you're doing to make sure that the people of Burlington, Oakville are supported is incredible. I mean, I hope that everybody on the Zoom and anybody that sees this, after the fact on YouTube, Facebook, whatever it is, that they realize how much Dan Cooper is involved in their community because it's pretty impressive.
Well, it's funny. I mean, I've been in this business for 30 years, and I probably had a team from the very beginning, and I have a very small but yet productive team. We sell a lot of real estate, which is great. And I think that's just the passion that my team has. So, I mean, whenever I hire anybody, they got to have the same vision and passion as I do. And, you can see that in the way we run our business. So, I mean, it's the funny thing is though, like real estate has been such a great investment. And I'm kind of jumping in. I just got one quick story, but when I got into the business like 20 years ago, I would sell a home for $300,000, and the people who bought it would do nothing, just live in it and treat it as their homestead. And then 20 years later, I sell it for $1.5 million, and we'd sit at the kitchen table and we'd laugh to each other. And they go, "Oh my God, we're up over $1 million." And I'd always laugh and say, "Why didn't you buy the whole street?" And obviously at the time, 300,000 was a lot of money. But if you think about it, these people have all this equity. And so they're either upgrading or downsizing or changing accordingly because, everybody has, different life events, which mean they want to do something different in the real estate world. But at the end of the day, they've got a lot of built up equity. And so I started thinking, wow, why am I just selling them one home, getting to know them and having, a great relationship with the one deal? But there's so much more opportunity out there. And so that's kind of what got me turned on to your company. And so I'm gonna kind of jump in, and everybody who's online right now, I just want to introduce my guest tonight, my guest speaker, and it's Bobby Poom. And Bobby he's the director of investing for REC Canada. So they move probably 700 to 1,000 deals a year, units throughout the GTA. And the cool thing is Bobby has incredible relationships with all the builders and developers throughout the GTA. So I'm not talking just downtown condos. Of course, that's part of the mix, but we're going east, west, north, wherever the deal is. And more importantly is the fact that it's not just about buying product, it's finding the right builder, finding the right terms, getting the right product at the right time, knowing it's going to get built. And it's all about reputation and pricing and desirable areas. You know, obviously location is everything. So a natural segue for us was to go from just doing one deal with people and then obviously selling them a second or a third or a fourth property investment wise, because you know, if you can buy one, you know, money is so cheap right now.
Yeah.
Like I can't believe how cheap it is. Like a few weeks ago, we were talking 2.5%. Now we're talking in some cases you can get, you know, secondary financing for under 2%. And so it's almost a crime not to go out and borrow as much as you can and invest and buy something.
Yeah, I mean, I totally agree with you, but we need to make sure that people are doing it safely and securely and on products that make sense to what their goals are as well. That's actually one of the driving factors for myself having joined the REC team back in January, is that like I am an investor. This is how I've made my bones since I turned 34 years old, is in investment real estate. And and I mean, our biggest thing is to make sure that people are doing it knowledgeably and safely and securely. So sure, money can be cheap, right? But if you're going to go off and buy the wrong product for yourself, it can be a bit of a mess. So it's exactly why I love being on things like this, when we get to talk to an expert in the market like Dan, right? And then I get to add a little salt and pepper, I suppose, to that. No pun intended, right? But a little salt and pepper to what Dan does traditionally, so that we can make sure that people are expanding their wealth over time in products that make sense for them.
You know, we should step back and get a little bit and just talk about the market in general, because like, let's just talk about market stats for a minute. I mean, for me, the market is on fire.
Yeah.
And I'm talking a whole bunch of my businesses in the 905 area codes, and it's taken on a whole new life. So, you know, it's mostly pent up demand to a certain degree because the market is playing catch up. So if we look traditionally over the last 20 years, real estate has performed everything, and it's outperformed, you know, the stock market in many, many cases, just as a more stable investment that you can count on. But the big thing is, you know, we had a few setbacks the last few years. We had foreign buyers tax, probably, which was the beginning of the end in, I guess that was April 2017. So that took all the investors away temporarily. And then we had 5 interest rate hikes. And then in January of 2018, we had the stress test. And so that took about 1/3 of my buyers out of the equation, because suddenly people that qualified did not qualify. And so it just made investing and buying in real estate a dirty word for a short time period. And so then what happened after that? So the market was kind of wonky. And then just last Christmas, it started coming back to life. We had a fantastic December, January, February. And then what happens? We get COVID. And so suddenly we're shut down again, you know, to a large degree, because people are scared. People go to the sidelines. They don't want to invest. They don't want to talk real estate. They're scared. They're waiting to see what happens. And I get that. And so even back in April and May, I was saying, okay, by the end of June, early July, the market is going to bust out, because you can't stop people from buying and selling real estate. You can you know, turn them off for a little while. You can put them on hold, but people have to do their thing. And that's what we're seeing now. And so it's just the last 2 months, we have records being set. I'm trying to think, we're up 17% July compared to last year, year over year. 17%.
That was published by, so Zoocasa is the report that I know about, who said that Oakville as a whole, year over year, 17% increase. That's insane. I mean, it's amazing to hear for a homeowner in the Oakville area, I suppose, right? But like, what are your thoughts on that? Is it safe?
Well, you know, it is. And I think the market's playing catch up. So is it sustainable? No. Do we want 17% per year? No, of course not, because you know what happens then. it's going to send the market into a tailspin and probably into a recession. But if you just look at the number of sales right now, we're up 30% just in raw new sales. So we're playing catch up, as I said, and that's all good. But typically, our market has performed with the pace of inflation for 20 years now, where we're getting like 4, 5, 6% per year. And that is a beautiful return. So if you just look at the beauty of compound interest, and the whole trick is to have more than one property. So if you have one property, that's fantastic. But if you have the second and third property, then the magic starts to happen. And so that's what kind of got us turned on to figuring out ways where people can use other people's money. And it just so happens that money is so cheap right now. So if you can get 2% money and you can go out and buy the right investment in a market that is poised for this kind of activity, it's golden. You can't lose. And so to take it one more step, you know, I've got a really good database of great clients that I've dealt with over the years. I'm trying to give them some VIP products and services. And so that's why you're here, Bobby. I mean, I wanted, you know, I wanted the number one real estate development team in the country to help me source out product, because anybody can go out and see a lineup of people standing outside, camping overnight, trying to find a unit, which may or may not be a good deal. But you know, and I know that typically when those lines are formed, they've gone through probably 3 soft openings. Every time they put the prices up, the terms become less, you know, the free parking spot is gone, and so on and so on. The terms are gone. And so it's so critical to get the best information firsthand on the product where the builders are the best builders. So I guess what I've said is the market's on fire and it's fantastic. So it's now time to educate people that are online and let them know that it's safe to go out and consider a second residence or third or fourth, an investment property. So I don't know, Bobby, I'm going to throw a question at you. What would be the 5 ways you would benefit right now from, say, a real estate investment?
I mean, I would break them down as simply as possible as these 5 things. Like you said, it's cash flow. That means that you're not out of pocket for any particular investment you're making. Traditionally, however, I would try to have a new investor understand that you're going to find an equity marketplace on one end of a sliding scale and a cash flow marketplace on the other. And it's pretty rare that you can do both at the same time. That would be a beautiful mixed market, right? And everything that you're talking about in Oakville at the moment makes that hard to believe. 17% appreciation would mean large equity, but very little cash flow in theory. So normally the message to an investor is drive until you cash flow. From your address specifically, that would be towards, call it Brantford, Welland, around the lake, you know, all the way to Woodstock. That makes a lot of sense to me.
Well, following the GO train, wherever the GO train goes, you know that real estate is going to appreciate. So yeah, all the way to Niagara Falls eventually.
Exactly. So cash flow would be the first one, and that would be any dollar left over after all debts are paid, all required expenses are paid, everything is paid for, and you're left with $1. That's $1 that you can take to the movies if you'd like. Knowing Dan the way that I know Dan, it's probably a bottle of scotch on the way. I don't know, but that would be the first way, right? So that's what we're always sort of shooting for, to get to as close to that break-even dollar as possible so that people aren't actually out of pocket on a monthly basis. Secondarily, just owning the place. And then in theory, having a renter, right, that you're going to lease this thing to is going to pay down your mortgage. So that mortgage pay down becomes new principal, new equity for any savvy investor to then be able to reaccess over time. So there's your second way. Your third way is what we would call passive or market appreciation. Okay, that's the 17% currently in Oakville. So if you happen to own a property in Oakville and you've seen that type of return, in theory, I mean, honestly, Dan, that's $170,000 on $1 million property, which isn't all that uncommon in the Oakville area, in the Burlington area, right? So that's just for sitting around in the marketplace, but you have to be in the market in order to receive that type of thing. So sitting on the sidelines, as scary as it may be to jump in at some points, doesn't do you any good when the market is functioning as it should. And to be frank, right, every time that I look at an investment, it's 3% appreciation. That's actually the national average over the last 80 years. Mm-hmm. Like, those are documented statistics. I never run anything much higher than 3% because it's safe. And that's the way that we would run our numbers when we consider an investment. I'm on to the fourth one already here. So the fourth one would be what I would call forced depreciation. So that would be if I was to buy a vacant lot or invest with a developer on what is currently a vacant lot so that I can build something new. I'm forcing new appreciation. Something new where something didn't exist before would be the easy way to say that, though I probably tripped over my tongue, right? The last one, the fifth one, is that because a lot of these dollars are borrowed in order to do that, whether it's a mortgage, whether you're just putting like a home equity line of credit on your current property, right? All of that interest can then become tax deductible. And there are a ton of tax deductions and tax benefits to owning a secondary or tertiary, or well, how do you say fourth fancily, right? Like any of those can actually come with added tax benefits to your bottom line as well. So if I was to break down 5 ways that you win in real estate, as simply as I could, it would be those 5 things.
Yeah, yeah, it's pretty neat when you explain it like that, because there's a lot of reasons for people to take advantage of this. And there's more good news this week. The mortgage experts are saying that the Bank of Canada is going to reduce the benchmark qualifying rate, aka the stress rate, or the stress test. And so
Yep.
right now we're I think 4.94, and they're looking at it going to 4.79. So obviously the banks are, they understand they're trying to stimulate the marketplace, and it's a good thing. So there probably will never be a better time to invest than this, because money is almost free. And to that end, if you look at what happened during the pandemic, the day the pandemic was announced mid-March, the stock market it was gone the next day. And so it's very fickle. And a lot of investors can't handle that kind of, um, sensitivity. Whereas real estate basically went up 1% during the whole pandemic, which is incredible. And so it
Yeah.
was not affected.
It is incredible. Like I have a good investor friend of mine who will say things like, the stock market is so crazy that if the wind blows the wrong way in the Sahara, oil drops. Who knows, right? Like, and I don't know, and I'm just not that smart. But what I can tell you is that people always need a roof over their heads. So to be in the position to be an investor, to provide a roof over their heads, anybody's heads, right,
Yeah.
can mean that you can then access all of those benefits that we just talked about at a great potential rate of return. You just kind of have to know what you're doing. And this is exactly, again, I'll say it until I'm blue in the face, this is exactly what I love about the investment series itself, teaching people that they can, in fact, do these things and access these things. I want to ask you a question. Do you see the stress test lightening just a little bit, helping new home buyers, first-time home buyers, get into the marketplace? Is that something that you see?
100%, because without the first time buyers, we can't have the move up buyers doing their thing. So, the whole thing has to work. We have their own, there's a complete real estate ecosystem, and all moving parts have to make sense and be in sync with each other. So, absolutely, we're going to get a lot of fresh buyers, new buyers into the system. And if anything, that's just going to put more pressure on the whole structure. And as it is right now, we're running with very limited inventory because there's so much demand out there. There's very little to choose from. One more reason to grab something if we can, from an investment perspective, because if we can buy an investment property that's going to take 3, 4, 5 years to build, just think of the potential for built up equity during that process, where you may throw 5% into the equation, but at the end of the day, if the property's gone up 20% by the time you close, look at your ROI. It's a beautiful thing. So
Yeah, especially when you're only putting 20% down as a
yeah,
whole, but
yeah,
over time, like we'll get to that. I know that we want to talk about deposit structure, but it's something that I'm not sure a lot of people realize is that just being in the marketplace can be in and of itself an investment. So like this is where I would want to encourage any first-time home buyers or younger individuals that have just never purchased and kind of just thought of themselves as renters. Money's cheap. The ability to get in has all of a sudden become just a little bit easier, and you can become an end user is what I would say is the term, but it makes you an investor to a degree, especially when you're doing it the way that we're about to talk about, so that you don't actually need to carry any debt over the next 2, 3, 5 years in some cases just to get into the marketplace. You're winning from day one, right? And now that it's a little bit
yeah.
easier, it can work really, really well for people.
Well, for me, I feel like I'm a kid in a candy store sometimes because rates are so cheap that it's like, I gotta go buy something, because I did a lot of my investing 10, 15, 20 years ago when rates weren't that fair.
Yeah.
And, I remember the first bungalow I ever bought. I was, I think, 21 years old at the time, and it was a dump, but I just wanted to get into real estate. And so the first mortgage was at 12%, and the
Oh,
second mortgage was at 19.5%.
oh, wow.
And so it was $10,000 at 19.5%. So I did the math after paying it for a year. I paid that second mortgage down, which was $10,000. In 1 year, I paid it down $6. So basically, you can't down pay your mortgage. You're screwed. It's like a line of credit that just goes sideways. And so to think that money is so cheap right now, everything works. It even makes numbers in the city work again, where it's positive cash flow, whereas that was unheard of when it's 5, 6, 7, 8, 10%.
Yeah.
Because for a while there, we had to shop Hamilton and go way out to the burbs to try and find the deals. But now we can find deals right in our backyard because the numbers work based on the low interest rate. So it's win, 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 win. So you can almost choose where you want to go. And so that's another thing that I'm going to talk about with you in a minute, because I know you've got a lot of projects and opportunities for people out there. And it's really getting them in on something that they're comfortable with. Maybe they want something in their backyard. Maybe they want something, it doesn't matter. It could be anywhere in the GTA, but I know we have a little bit of everything going on right now. But Toronto itself, I know you do a lot of condo sales as well. And real estate during the pandemic did very well, didn't it?
It did. It did. Everything really hung on, really, like you said it before, like a 1% increase in pricing over the course of the pandemic. And it was just sort of like a holding pattern, and like it's a wait and see. And that's the beauty of this. You're going to hear me say it a bunch of times over the course of the evening, but like a 5-year buy and hold, any length of time, a buy and hold is the best way to go. So people just kept holding. They might not have been buying at the time, but it's continue to hold and continue to hold. And inevitably, real estate continues to pace because of how much demand there actually is out there. So our spring market effectively pushed to the summer, right? We saw a ton of launches delayed. And now all of a sudden, all of those launches that have to be done in the year 2020, builders can't carry the debt any longer, whatever it is, they're all pushing to the market now. So you're seeing just ultra competitive pricing
Yeah,
to be able to have investors gobble some of these things up to make sure that, again, everybody's building wealth safely, securely.
Yeah. Well, when I look, we have a ton of people listening in. And so obviously they're here because they're curious about what we're going to say from an investment side. So I'm going to jump right in. Bobby, obviously you've got the best investments, and we'll explain why, because a lot of that is based on the goodies they come with. Because since you know the builders and the developers intimately on a first name, personal basis, you're getting the best product before it gets elevated through rounds of price increases and so on and so forth. So obviously a lot of my business is in the West End. So we're talking Mississauga, Oakville, Burlington, right out past Ancaster. Having said that, what have you got that's local that you could tell me about to start things off? I know there's one project in Oakville that's done west.
Yeah, Dun West is a super interesting one. They launched it to our broker network last night. So I was actually down in Oakville both last night and then in town talking with your agents about it this morning.
So it's brand new.
It's brand new. It's brand new. But as of today, they start accepting worksheets. And we'll kind of go over what that means here in a few minutes. But Dun West at the corner of, I'm going to say it wrong, so don't shoot me here, but it's Nayagawa and Dundas.
Hey,
Right?
like a true professional, you nailed it.
There we go. There we go. All right. So amazing school district. I'm told that you could go get a golf membership at Glen Abbey and play the Canadian Open if you so choose. It's the new development corridor, if you will, in Oakville. So they're launching, and it's got it's beautiful, to be honest with you. You saw some of the scale modeling, all of the stuff, and you guys actually have it available for your people. Actually, if I'm not mistaken, you guys are going to send an email out shortly after this with all of this information for Dun West on it. Amazing.
And you've got a 2-week exclusive on it.
Yeah. So because of our standing, so we leverage the REC name and our relationships over time, and that's exactly what we're doing with a partnership with Dan Cooper Group, is to be able to get in first pricing, first access. It's think of it as being the first one through the door on Black Friday. Everything is there, and all of the best sales are there, kind of thing. So yeah, we've got first access. It doesn't actually go to the public for, I think it's a 10-day period, so it's like a 10-day exclusive, and you and I can help some of your people right there in your backyard get into some of these things. So it's amazing.
Yeah, and as far as I heard, the pricing is really, really good. Aren't you under $900 a square foot on that project?
Yeah, they are. It's somewhere in the 850 range. So let's just call it sub 900 to be safe, right? That's the average across the building. But as an example here, so we launched a project in Port Credit that was closer to $950 a square foot. That was a month and a half ago. Okay. We launched a project in North York. This was just 2 weeks ago at $1,275 a square foot. If I'm not mistaken, that one's been increased to $1,350 a square foot. Right? And we're talking North York, just north of Yorkdale Mall is effectively
Wow.
what it is. And then when we get to talking about what different areas are like I'll give you an example of this. Okay, I don't live far from Yorkdale, right? And I could buy a small bungalow and convert it into a duplex in the 750 range last year. It's worth $1 million now. All right. People are also then buying just north of me at this project at 1375 a square foot. That makes a 2 bedroom a $950,000 proposition. And then Oakville is rated the #1 marketplace in all of Canada by Money Sense magazine last month. And we're talking about sub $900 a square foot. The amount of pressure that that's going to put on to any particular project, let alone the first one to market, and what seemingly will be the cheapest of those things, is going to be
Yeah.
insane. They're going to get a ton of interest based on this pricing.
Okay, so that's one thing. So right now, going into it, you're getting first round pricing, 850 a foot. Um, it's going to take how many years to build the building? 4?
They're projecting June 2022.
Okay.
And normally when we do these things, I would say always build in a year. And in all the years that the REC or the Dan Cooper Group's been around, how many builders have delivered on time? Right? So I would say add a year, normally at least. But this is a relatively small project. It's 8 stories, ultra boutique. It's beautiful, and it happens to be tied then to Green Park. So Green Park is a
Oh,
builder, which is
fantastic.
yeah, it's an incredible builder with an incredible reputation. So it's relatively small for them by their standards, which means that they're just going to get after it. They're going to get it to market as quickly as they can because they can.
And some of the other things that people want to know about, okay, so pricing is right. It's a good builder. It's in Oakville, which is fantastic location. Obviously, so it's a desirable area, but more importantly, um, deposit structure. Let's talk about that. How does the money play out?
So for this one specifically, relatively simple, and they've actually made it just ultra competitive to what mostly we see in the market. If I was going to say mostly in the marketplace, I would say 5% this year, 5% in 90 days, 5% in 120 days, and that pushes a lot of the money into the project early. Right? And that for an investment, that doesn't actually make a ton of sense. For an investor, you want to see as little of your own money in as possible at any particular time. So for this one here, I'm just going to look down to read this to make sure I get it right. So it's $5,000 on signing. It's peanuts. Okay. And then it's 5% in 30 days, 5% in 6 months. So you're looking at 10% in the first year. And then it goes 2.5% in 12 months, 2.5% in 18 months, and a remainder 5%, not until occupancy. So that's when you actually take the keys in hand. And that's actually an important date because we've also then got the ability to lease upon occupancy, which basically means they give you the keys and you can put them in one hand, take them to the other, get them to your tenant, who's then going to start renting day of, if you
Beautiful.
guys are really, really good at this as investors. So the whole point of this then, I'm going to just use round numbers so that I can illustrate this the right way. If I was to buy a unit at $600,000 at Dunn West, that means I'm going to put in 10% in the first year. That's
60,000.
60,000 bucks. And then I want everybody to try to remember to go back just a little bit to what we talked about. I am definitely not going to use 17% appreciation to to talk about this one, but I think that 5 is fair, and 5 is actually really easy math for me. So I'm just going to use 5% appreciation. That means that if I put in $60,000 this year, I can actually see a return, not physically, but I see a return on paper of $30,000 or 5% of $600,000 in the first year. So my effective rate of return on dollars invested is 50%.
Amazing.
Right? If I go to year 2, I'm actually only putting 5% in. So if the same held true and we were ultra conservative and said 5% again, I'm putting 5% in to then make 5% again in year 2. So now I'm compounding. And the real benefit is that if I'm going to buy at 600 and I'm going to do like 1 year of appreciation, it's going to be worth 630 the next year. That's what it appreciates at, not at 600. But for ease sake here, I'm just going to say I'm going to make 100% of my money in year 2. And if I combine years 1 and years 2, I'm going to make an effective rate of return of about 75% on my money. Dan, is your stock portfolio doing that in your RSP right now? No, and I'm just being smart, right? Yeah. But the whole point of this then is that you're not actually outlaying the whole $600,000. All of these dollars that you're putting in, okay, can actually be leveraged as well. And then the real beauty of this is that, yes, you're making a rate of return on those dollars from day 1 because you hold real estate now. You're leveraged slightly. And if you're ultra savvy, you've got a home in Oakville or Burlington that you've got a home equity line of credit on. So you're using those dollars to go into this deal. And you're making then a tax deductible investment for the interest on your home equity line of credit. So there's a million little things that go into this that can make these types of things ultra lucrative. Yeah. And because Dunn West has spread this out just far enough to make sense for people, right? Like 75% projected return on investment. And we're just talking about appreciation at an ultra conservative level in Canada's most desirable marketplace to live in. I think it's just fair to say that it's an unreal opportunity.
And to be honest, I think your 5% appreciation is low, and I know you use a conservative number, and here we are with 17 points with no relief in sight. Like just last week, we had 6 deals that went down on resale product. They all sold over list in multiple bid situations. So what does that tell you? So prices are going to go up and up and up, and this pent-up demand is going to be here for a while. So again, you can't stop the market. We have a lot of good immigration coming into the GTA, and they need homes, and we probably need 50% more homes than we have right now. So, this is the time. I want you to touch on assignment, because let's say somebody buys a product and then their life events change in 2 years, and by the time the closing comes, they're not where they want to be, and they want to get out of the investment. Tell me, because I know some builders in the past would not let you assign a deal.
Yeah, so an assignment is effectively taking your interest in the contract of the deal itself, right, and moving it on to somebody new, and that somebody new would have to pay you for it. So what we work to negotiate at any particular deal that we're then going to push out to investors as good product has an assignment clause in it. So that's the ability to say, like, look, I've purchased at $600,000. The market's appreciated 5% year over year. We're just going to call it's worth 660 now, but I can't close. Life circumstances have happened to me. That means Dan could swoop in theory, and buy me out at, let's call it 630. So it's a win for him. There's some baked in equity there. And there's a win for me. I've actually made a $30,000 profit on the, $30,000 or so that I've invested. So it's a real win-win. It's an exit strategy. Now, I will say this out loud because I truly believe these things, and we need to protect people. You and I, Dan, and anybody in the real estate industry realistically has a responsibility to protect their people. So what I will say is that we do that. We negotiate these assignment clauses so that somebody can protect themselves with a potential exit strategy that didn't exist before. Right. If I was going to be working with somebody who said, well, I just want to assign and I just want to do it 15 times. Can you imagine the example here? Somebody bought 3 years ago, didn't predict COVID-19 pandemic happening, and then needed to sell because they've got 3 or 4 of these things that they bought, right, and their plan was just to assign that, and nobody's buying anything any longer. Can you imagine the stress that would bring to somebody's life? No, thank you. But it is an important exit strategy. I think any great investment has 3, 4, even 5 potential exit strategies. So that's a good one to have touched upon for sure.
Well, that's really the key thing in this whole discussion is I've uncovered the right company that has the right product, and I know you have more. I want you to touch on some of your other investments as well, but I'm trying to create some special VIP Dan Cooper differences here because I want to recognize and honor the people that have been loyal to me for all these years. So really, to me, it's a no-brainer on many fronts because real estate is doing its thing right now. Interest rates are low. Um, you're getting the product first before there's any price increases, and that's huge because when you drive down Dundas Street, North Burlington, and there's people lining up trying to buy something, well, they're probably getting the third round of price increase. You're identifying the buildings that are priced right, i.e. the 850 a foot, because I know a lot of product in the city down on Yonge Street is hitting $1,400 to $1,500 a square foot. I've
Yeah.
seen buildings selling in Yorkville for just touching $2,000 a square foot. So you know what? As much as we don't want Toronto to become a national city, in the big picture, it's becoming a New York in many fronts, and it's just
Yeah.
going to continue to appreciate. So we've got desirability, we've got location, we've got pricing, and the fact that Dunn West is Green Park, it's going to be built. It's going to be built in time, and it's going to be quality product. Deposit structure is fantastic. The right to assign is important to me because you
Yeah.
never know what's going to happen. And I know sometimes you even get free assignment because I've bought product in the past where I didn't pay a cent to assign. So these are all things we can negotiate for our people.
Yeah.
Wow. And so even the ability to rent the second you get occupancy is a big deal.
Yeah,
So
that doesn't always exist. I think that's something that there's a misconception with what occupancy is. There's an occupancy and registration,
it's
right? So
possession.
registration is actually when you then start paying the mortgage. So there's this interesting time frame where the builder wants to put a lot of its costs onto myself as the buyer, right? So they say, well, here's occupancy and you can start paying certain things, but one of those things is not my mortgage. So now I have the right to rent that out with little costs to myself, just whatever the builder's asking. So
Yep.
the renter is then paying those costs, and I'm going to see a jump in cash flow, which is something, Dan, we should really touch on the first access to this. And remember earlier in our conversation, we talked about an equity marketplace on one end and a cash flow marketplace on the other. Buying at something sub $900 a square foot actually creates the best of both worlds. I actually believe that we're going to be able to rent out a majority of these things at Dunn West for $2,000 a month. Depends on the product, obviously. One in a den, 2 bedrooms, but that's going to be enough to keep you cash flow neutral in most cases, which means that like you can't normally do that in the GTA. It's very, very difficult to do. So all of a sudden we've created that perfect storm of things, and all somebody actually needs to do is put their hand up. As far as I can tell, all somebody needs to do is go to dancooper.com/investments. They're going to see a portion of these things, right? Or they can book a meeting with you themselves, can't they? Meet with dancooper.com.
Exactly, 100%. I'm all in on this one. This is a little pet project for me. I mean, I have fun on the resale side, but I'm getting a real charge out of getting my friends and business associates involved in top-notch product that is new to the market, that's in many cases pre-con. Doesn't have to be a condo, it can be townhouse, semi, it can be whatever people want it to be. We have so many projects. So I'm going to make sure they're all posted on my website, and I will make myself available to have one-on-ones with people that are interested because this is fun. Because it gives people, the general layperson, a chance to build their real estate destiny and wealth in real estate, their legacy for their family going forth. Okay, so you touched on Dunn West. Now let's go to Burlington. Lindor, tell me a little bit about that.
Oh, so yeah, Glendor. Urban and traditional towns. So it's a little bit different investment style. This isn't a mid-rise condo building, but this is actually owning a townhouse. I actually see that one as just a fantastic opportunity for a new end user to get into the marketplace. So they're not paying full freight for the lot value and everything that comes along with that. But it's a beautiful project. I know that if somebody was going to put their hand up about that particular thing, that you guys have the packages there. And I just really like what's going on there as well. Price points are really, really competitive. It's just a different type of investment, if you will. So yeah, there's that. If we went the other way, I just got word. I think we were on here already when I took this phone call, but a project called Artform in Mississauga,
Okay.
right? And it's in Cooksville, 17-story building. The same builder has 4 projects over the next 10 years in the same place. So that builder is basically taking it upon themselves to redevelop Cooksville.
It's going to
Right?
become the new, Mississauga City Center.
Yeah, exactly. Think Square One 10 years ago. That's what that's going to look like. And like, I mean, we have that on good authority because the guy that I report to at the REC Canada is at the launch event for that one tonight. And he is working diligently to make sure that the people that follow Dan Cooper have the ability to put their hand up about that one as well. It's on the Mobility Hub, and it's also sub $1,000 a square foot. So I don't think that it's going to go as low as Dun West, but this is exactly where I would turn to everybody and say, invest where returns are best. That's always my message to people. I don't think that you need to be fearful of it when you have an expert like Dan Cooper Group, experts at the Dan Cooper Group, okay, in your corner to make sure that, yes, this can happen for you. So we're not even really driving all that far, and it's beautiful when it's in your backyard. It makes comfort and knowledge about your own marketplace that much simpler to apply to what your investment is. But everybody, just invest where returns are best. Find where you're comfortable. But the biggest message is just to act. Put your hand up if you want some more information. Book a call. If you're ready to go, fill out a worksheet. It's going to be in the email that you're going to get later tonight anyways. Fill it out, lock it up, and talk it through.
Yeah, no, that's cool. I mean, I have a passion to make sure this all works, and I'm relying on you and your company because obviously you're the ones turning over the stones, finding the right product. Because many people don't have the time to go and try and develop a relationship with a developer and get the right terms. They're not going to, So this is very exciting to me. So I feel like I'm doing my clients a huge service and I'm taking advantage of a market that people don't realize how good it is.
Yeah.
So I'm all in. So that's pretty cool. Bobby, I don't know if you want to talk about more of the projects or we just send them to my website. I think we've kind of accomplished what I wanted you to say tonight.
Yeah, I mean, like, look, I'm always happy and I'm always available to help. And what I will say is that I want people to understand, anybody watching this live or after the fact, is that, like I said in the very beginning, I'm an investor, and to find somebody like Dan Cooper with the reputation that he's got in the first place is pretty incredible. And then to find out that he's actually invested in making my investments, my wealth building, that much more successful, guys, it's a no-brainer. I'll say that till I'm blue in the face too. Working with the Dan Cooper Group is an incredible way to build your wealth, bottom line. I'm not going to talk about any more projects because we're just going to get them out to people that want them. All somebody needs to do is raise their hand. But before we go, Dan, for the first time ever on a Dan Cooper investment series webinar, we've got questions to answer. Are you ready for these?
Sure.
So Derek Vernon has asked us a couple of things. Does it include parking spot in a locker? And I'm assuming here it's Dun West. And he's also asked what's the monthly maintenance fee. So all of those things, Derek, will actually be in the email that you'll see. I think, Dan, you guys have it set to come out about an hour after the webinar itself, right? But quick answers here. So the monthly maintenance fee is about $60 a square foot. Okay, which is super competitive. The last one I saw was closer to 95 cents a square foot, if I'm not mistaken. And it doesn't include a parking spot in a locker, but with the first access that, yeah, with the first access that DCG has to this thing, I have it right in front of me. I'm just going to pull up my little book and make sure that I get the number right, but I am 99% sure that it's $10,000 parking and locker, which is a $35,000 savings for when they take it to the public. That, guys, $35,000 is a 5% portion on a $600,000 unit by acting first. That's the importance of acting now.
Wow.
Yeah.
I love it. Yeah.
The other one, we've got Jill here. She says, "Hi Dan, hi Bobby. Thanks for all this information." She must be talking to you. You're the one with all the information, right? But for a beginner looking to invest in their first investment property, can you discuss the pros and cons of looking to buy condos versus townhomes versus detached and mature areas? So, Dan, tell me just real quickly, if you wouldn't mind, some of the average price points across Burlington and Oakville? I know there's a ton of micro markets, but in some of the more mature areas that you can think of.
Well, I mean, right away, detached is going to be a bigger nut. So you have to have more downstroke in order to get right into detached these days, because even townhouses in Oakville and Burlington are $700,000 to $800,000 with ease. It's hard to get into detached much under 850, whereas condos you can get in at 4, 5, 600. So you got to look at it like a stepping stone. You know, you got to walk before you run. You got to do your first investment, get your feet wet, get comfortable with it, feel good about it, make some money, and then refinance and take this free money that we're talking about tonight and pour it into your second and third and fourth property. I mean, it takes time to, this is not a get rich quick scheme, and we never will say that. There's risk involved with everything, but we know how to limit the risk to the point and recognize the obstacles and just take people through the garden path, because we're going to give them the best terms all the way through. So if someone's a first-time buyer, you probably want to start off slow and go with a condo. If you have more downstroke, or you can borrow from the outlaws and, you know, friends and family and put money on your visa, what I would do is buy as much as you can afford. Max it out right now, grab as much of that free 2% money as you can and buy as much as you can. Talk to your lender, your mortgage broker, and get rate protection for up to 120 days. So if rates bounce up the next day, you're protected, then you jump in. So step one, identify the opportunities. 2, get pre-qualified for financing. And then 3, talk to me and I'll give you some insight as to what to do.
Yeah, I mean, Dan, you nail it, right? Rome wasn't built in a day. You're not going to go off and buy some 20-unit complex tomorrow. You're probably also not going to buy a $1.3 million home on the lake and expect it to cash flow. And I'm probably insane to believe it's $1.3 million on the lake. So there you go. Yeah. But what I will say, right, is I think that people should change that order that you just gave them. Well, it's great to have a pre-qualification, and it's great to sort of identify the opportunities. Here's what Dan Cooper Group is doing for you, everybody. It's that they are identifying the opportunities. You need to talk to them first. Make that your first thing. It's literally as easy as going to meetwithdancooper.com, booking a call, and jumping on the phone with somebody who's going to understand what the opportunities are, so that you can then understand the differences between buying a condo, buying a townhome, buying a detached in a mature area. It's probably too broad to cover all here, Jill, but I hope that some of that helps, because frankly speaking, get your feet wet. Get your feet wet in your own market when the time is correct for you, and when opportunity like something like Dunn West or Artform in Mississauga or Glendore in Burlington, which are all literal opportunities that you can ask about right now, but when the time is right to act, you have to be able to act. That's what makes the difference between a good investor and a great investor, flat out.
Yeah, I can speak with conviction right now that prices are going to go up. And look what happened just in the last year in the city, you know, in the GTA, prices up 17%. Hello, you know, like jump in, please, please, please take advantage of something, and we can figure out what makes sense according to what their investment mix and their deposit structure is.
Awesome. Dan, this has been so much fun. I really appreciate it. I also want you to know that I look up to you a ton. So to be able to actually share some screen time with you is an honor and a pleasure. And like, I would love to do this again with you sometime.
Bobby, my pleasure as well. You were fantastic as my guest speaker, and we're going to have you back again shortly. Your company does great things, and you've got the right product. And so obviously it makes sense for us to talk and, you know, send the message to my VIP clients. Thank you.
It's my pleasure. Thank you. Have a great night, everybody. And yeah, I guess that's it for this one. I look forward to talking about some of these investments with those of you who want to put your hand up.
Fantastic. Okay. Well, that's a wrap. And until the next one, we'll keep doing this. Thank you.
Awesome. Thanks so much, Dan. I'm out of here, everybody. Thank you.
Take care, guys.